You're listening to The Real Investment Show.
So I had an article written for today that I postponed out until next week because I wanted to write an article on this, what was going on between Israel and Iran. And of course, now it seems outdated already. I just wrote it yesterday because again, this morning futures are pointing higher. Markets are looking past this already. And that was kind of the synopsis of this article is that, be careful. Over the weekend, I got just obliterated by emails over the weekend on, oh my gosh, is this going to crash the market? What does this mean? And again, I got so many emails around this Israel-Iran conflict. I've felt the need that, to write an article to at least have that data out here for you. So if you go to realinvestmentadvice.com or onto our Substack page this morning, at Lance Roberts, Twitter at Lance Roberts. By the way, you can watch if you're watching our YouTube channel, you can also watch us live on X as well as we stream at the same time. But anyway, so I felt compelled to write this article just to have kind of the data out there for you on what historically has happened around these conflicts. And, two things about this are important, which is first, we've talked about this market's being very overbought short term. And be careful about allocating capital. Markets are overbought, they are extended, and but that doesn't mean you're going to have a major correction. You could just have a consolidation where markets just kind of move sideways a little bit, a little bit of a pullback, not much. But you need some type of event that causes the buyers to step back from the market. And then sellers who are the ones selling to the buyers, they go, okay, well, I'll sell at a lower price if you'll just get it off my hands. And so something like Israel-Iran would certainly seem to kind of fill that bill for some type of event to cause a bit of a short-term correction in the markets. And as we've talked about, we want to allocate more capital to equities, but equities are very overbought here, particularly in the stocks that we want to own. They've had big runs, and the ones we want to add to just really need a bit of a respite here to allow some capital to get allocated to those. But, again, I'm not looking necessarily, and this is one of the confusing things about investing. Markets are overbought. So you go, well, I'm going to wait to invest capital until markets get oversold again. And so I'm going to wait for this big pullback in the markets. That doesn't have to happen. You're not looking for lower prices to invest capital. Mike and I touched on this last Thursday, but again, as we talked about, you're not looking for lower prices, you're looking for a better risk reward. And those are two, and you go, well, Lance, that better risk reward, that means lower prices. Not necessarily. If markets just go sideways, or if a stock you want to buy just goes sideways for long enough, it'll give you a better risk reward entry point because it'll work off that overbought condition, positioning bias because of that consolidation process. And we are seeing the markets kind of consolidate here. Really, since May the 12th, markets really haven't gone anywhere, just kind of up and down. And so we've been kind of working through this consolidation process since May the 12th. And again, we'll see what happens. But it's important to remember that we're not looking for lower prices. We're looking for a better risk reward. And, I could even potentially pay, it's hard to kind of fathom, I get it, is that I could pay a higher price for a stock in the future than today and have a better risk reward entry. And I know that's kind of hard to wrap your head around. It's like, well, then why didn't you just buy it here? Because at $50 today, the risk reward is negative. I've got, a 1% upside and a 3% downside. In the future, if it just kind of consolidates and grinds sideways, I could pay $55 for it, but have a 3% upside and 1% downside, even though the price is higher. I know that's hard to fathom. I get that. But it's important to understand how markets work. And what we're trying to do is invest capital when we have the best risk-reward setup. Now, currently, we don't have a really great risk-reward setup in the markets. And this is something that I actually kind of pointed out in this article over the weekend, and here's a chart of it. What this shows you is basically just the current setup. I've got about 3% to the upside, but I've got roughly about 5% to the downside. And so that's not a great risk reward setup right now. Again, it's not terrible. I mean, I could certainly potentially invest some capital here, but it's not a great setup. I've got more risk to the downside right now, especially with, kind of momentum indicators, very overbought, kind of your overbought conditions, more in overbought territory than not. The odds are we're going to get some type of pullback here over the next 2 weeks, 3 weeks, 4 weeks, particularly as we go into earnings season. What causes it, I don't know. But, again, we'll find out. But again, that's the whole point of what I'm trying to stress to you this morning is that when you take a look at markets and, potentially where we're, kind of what's happening, this is the things to pay attention to. So let's talk a little bit about history for a moment and, a bit about what happens historically during conflicts, because that's the big concern. Going back through history, and Bank of America did this really good, Carson Research, my apologies, did a really good analysis on Friday. Just basically going back and looking at previous conflicts, previous events, and what returns were over, the next 3, 6, 9, 12 months. And what you'll find out is that about 73%, you can bring the table up real quick, about 73% of the time, markets are higher over the next 12 months, even though you have a lot of volatility potentially over the next month or 2 or 3. Now, it was interesting too, because when you look at this table, immediately some, kind of big numbers jump out. The Yom Kippur War, I know there's a big market decline over the next 12 months. Well, that also coincided with a big recession in the economy and the bubble in the Nifty 50 popping. Same thing in really kind of 2000-ish. We had, the bombing of the USS Cole, which led to pretty negative returns over the next 12 months, but that also coincided with the dot-com crash. So there's some other things that you have to extrapolate out of these returns. It really wasn't that conflict that caused the big decline in the market. There were other factors that had nothing to do with the conflict. But even with that, even if you just strip those out and just say, okay, let's just assess it all to, the USS Cole bombing or 9/11, whatever it was, let's just assess the entire sell-off to that. Those are still one-off events more than anything else. And those had to do with very high valuations in markets and a lot of other financial imbalances. But overall, most conflicts tend to end pretty quickly. The markets tend to look through these. And here's a history of the S&P 500 going back to 1900 with kind of events labeled, kind of along the way. In most cases, these events, unless they're tied to some other type of a big event, like the dot-com crash, the financial crisis, these tend to be fairly short-lived. And markets kind of look through them fairly quickly and then immediately kind of move on towards what's next, which is the only thing that matters for the markets. And this is the one big takeaway from this entire conversation. All the markets are doing is looking at Israel and Iran right now and go, what does that mean for earnings in the U.S.? It doesn't mean anything for earnings in the U.S. And that's why markets are already looking through it this morning, because the impact to U.S. earnings for the mega cap 7, right, are not going to be impacted by what happens between Israel and Iran. And that's what markets always look for going future. Now, why, for instance, why did the dot-com crash cause a 50% decline in markets? Because everything that the people were betting on in terms of future revenue growth for these dot-com companies turned out to be mostly false. And when Enron blew up and WorldCom, Bernie Ebbers went to jail with WorldCom and Global Crossing went bankrupt, all of a sudden, all these theses about the future of the internet and all this money that was going to be made and all these balance sheets that were showing these massive revenue projections all went up in smoke. So all of a sudden, despite 9/11, despite everything else that was going on. That's what drove the markets lower, because the markets had to completely reassess for failed outlooks on earnings. Same thing in the financial crisis. So Israel and Iran, while important, and look, and don't get me wrong, I am not dismissing the tragedy that's going on right now in Israel and Iran. It's important. It has geopolitical risk tied to it. But from the market's perspective, which is all we're talking about right now, is the market's looking through it and saying that's not going to impact earnings. And until something happens that begins to impede earnings estimates going forward, the markets are likely not going to pay a whole lot of attention to this. Anyway, that whole article, it's up on the website this morning, and it's there for you. Just kind of goes through all the statistics, the analysis. So simply, you can find it at Substack, at Lance Roberts, on our website, realinvestmentadvice.com. We'll come back after the break, talk some more about markets, money, and one of the big things is that's dividing portfolios more than ever right now. Talk about that right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.